Hello, traders, and welcome to this very special edition of the Coach's Playbook, PSA edition. What we're going to do today is we've had a lot of questions involving price limits in futures products lately because there are some restrictions in the uh, funded accounts about where you can trade in relation to those. And there's a very important reason behind that. So we'll talk about what they are first and where they are. You're most likely to run into them in equity products. We'll talk about some other things as well. And then we'll explain why we have such a bee in our bonnet, so to speak, about people trading around those price limits. So, Hogue, as the veteran member here, why don't you tell us about equity future price limits?
Well, all right. The equity futures price limits are for the overnight trade. That's from 5 o'clock p.m. Central Time till the regular trading hour open at 8:30 a.m. Central Time. There's a 5% limit in movement in the equity products in either direction. If price moves 5% higher or 5% lower, you're going to end up in a situation where, let's say, the price has moved lower, it's locked limit down, and you've got a long position on that you're trying to get out of. What that means is you're not going to be able to get out of it. You're going to be stuck in a queue of piling up of sell orders at that price, but there is nobody there that's going to be able to buy them at that price. So you're basically going to be stuck in that long position down the limit. Now, at some point, the market's going to close and reopen with an expanded limit. Now, that's more likely going to be in the regular trading hour session. But what it means is anytime you're trading near those limit positions, you really have to be careful. Otherwise, you can get stuck and then be subject to continued further and possibly tremendous losses when the market reopens.
Yeah, that's the biggest reason why we don't want anyone to get stuck at those limits is because you literally cannot get out of a position if you're fading it. And you can imagine a scenario in which the market's locked 5% down. If something really bad happens out there, you know, God forbid there's a 10% move or something, it's going to happen like that after they lift it. And suddenly you're going to be down a lot of money. Let's just put it
Mm-hmm.
that way.
We
Mm-hmm.
saw that in the
And
beginning of this year. The first lock limit down we had before the market even opened up, the spread moved all the way down to 7%. I think we opened back up for about 10 seconds to 30 seconds, and the market went back to lock. So it's very quick to see these moves happen. And then on the flip side, a couple weeks later, we had a lock limit down that when we opened up, the market had rallied back above. So there's no telling what the market can do as soon as that market locks up.
It's almost similar to having a position like over the weekend where something bad happens or the price moves significantly at a period of time when you can't get out. It's almost similar to that.
yes, and I'll toss it over to Mick in a second as he is our risk manager here. But just to crystallize these rules, it's up or down in equities, equity futures, up or down 5% overnight. Once the market opens, it expands to, and now correct me if I'm wrong, 7% only down during the day.
Mm-hmm.
7%, at which point the market pauses 15 minutes and then reopens and expands to 13%. Same deal, I believe, with the timing. And if they reopen it and it goes all the way down, I believe it was at 20%. That is when they just shut it down for the day.
Right.
A last caveat
Unless,
is
yeah,
that in the last hour of the day, there are some different rules that you should, if you're trading any product, you need to go into the product features on the CME website and know exactly what you're trading. And Mick, if you wanted to give some flavor on either what you've seen or some of the other products you discussed and their limits.
Sure. Well, I just want to start off by saying anytime you're taking risk in the market, depending on whatever product you're trading, you do need to know the ins and outs of your product. If you're trading equities, know what the limits are, know what the contract specifications are. There's certain time of day functions in all of these products too. For example, old pit session closes, but you know, price limits are on a lot of products. It's not only going to be, certain products have percentage price limits like the equities, which are what we've been seeing price limit moves in the most lately. Other products have dynamic price limits. Crude oil is one of those products. Certain products have no limits at all. And other products like the grains, it's fixed to, how many cents that market can move. With some of those products, if you lock a limit down or limit up for one day, they can expand the limits. So these limits are, they're subject to change. That's something you need to know. And, if you're trading a product that's volatile enough to be having price limit moves, you really need to be on top of any, important information like these price limits and or changes. So that's what I want to start out by saying, know your product. It's the most important thing. We've recently implemented some rules in the funded accounts around not trading within a certain percentage of a price limit. This mainly pertains to equities because that's what most of our traders in the funded accounts are trading. If there's a 5% limit on the session, during the time you're trading, we don't want you trading within 2% of that price limit. So that means if S&Ps are down 3% in the overnight session, we don't want you trading because you're within 2% of that 5% price limit move.
Yes.
Now, in order to know what percentage change you're at, you can either do the math based off of the previous day's settlement price, not the closing price, the settlement price, or what I like to do is just pull up a quote board and throw net percentage change on there. It makes it very easy, very clear picture right in front of you. Oh, S&Ps are down 3%. I'm not going to trade because we're within 2% of that 5% limit move.
Sure.
If after the cash market opens, the stock market opens at 8:30 Central Time, those price limits get expanded to, well, I should say that price limit gets expanded to 7% to the downside, because now once stocks are open, there's no upside price limits. So if the limit's 7% to the downside, don't trade within 2% of 7%. So you see on your quote board that the S&Ps are down 5%. Don't be trading around there. We do 2% because that window of 2% to whatever the limit can be, it can happen like that. We've seen that, like Danny and John, and I think you as well, Jack, mentioned, when this volatility started, there were a number of evenings where we were locked the limit down at 5% in the equities, cash market opens, and we're immediately locked limit down at the 7%. Now, anybody trying to exit a trade, is going to whiff. I whiffed on trying to get a couple of our traders out. You cannot act fast enough. And that's where your risk is. You're stuck in a trade that you cannot get out of.
Yes.
And you can take much larger losses than expected. Auto liquidators aren't going to do anything for you. You need to get out. I think it's also important to kind of go back to talk about the fundamentals of a price limit move and how the markets are halted. Now, technically, in a price limit move, you still have an open auction, but whether it's locked limit down or locked limit up, it's an open auction. There's still trading taking place potentially, but in a locked limit down, it's actually the sellers that are locking the market limit down. There are so many offers at the lowest price that is possible to trade at, and there's not enough buyers hitting those offers to lift the market off that price. So you'll see typically on a bullish morning, if there's some news or something, there might be 50,000 on that offer or something like that. And you might see some trades, some people might be buying into that, but until the buyers get more aggressive than the sellers, that market's not going to get budged. And that's why they call it lock the limit down, because it's the sellers themselves that are locking it down at that certain price.
Yeah, that's quite the move to be doing, buying into the 50,000 limit there. And just for a quick historical perspective, the reason that this has become an issue now is for the longest time, it seems, they instituted these limits to bring stability to the markets. And we've gone through a long period when there hasn't been a ton of volatility. I believe election night 2016 was the first and only time that the equities had locked overnight until this March, when what was the final count? How many times did they lock? How many days? 4, 5?
It seemed
4 or
like
5
for
feels right.
several weeks in a row, it was 4 out of 5 nights,
Yeah.
4 out of 5 days every week.
And what Mick says is super important. We're not trying to punish anyone, but you don't have a strategy or something you've looked at statistically that probably operates in that 2% near the limit, wacky stuff happens, and it can go just like that because there's not a lot of people trying to buy there. But it's just not a great place. It's just algos run amok. It's
Yeah.
If you're a point and click trader, you want to be away from that.
Volatility and limits are no place to find out about your risk aversion.
Well, you could be right. You're gonna break your loss
Mhm.
limit,
Yeah.
very likely just from whipping around.
There's
So,
no sense in participating. Professionals don't participate during those times.
It's
sure.
not worth the risk.
And that's why you see thin markets, and that's why it's easy to whiff, because there aren't any bids to hit or offers to buy into at certain times.
And also, thin markets like that are just terrifying too. It's great psychologically. It's very difficult to keep your cool if things are just evaporating around you.
Mhm.
Yeah, Jack, you even mentioned the algorithms. Those all get shut off. Those are what help kind of create a market maker in this day and age. We don't really have very many people standing in pits making markets like we used to. These algos are the market makers. They're filling the bids and the offers. And as soon as we hit these locks and we start hitting limits, those algos are shutting off because they're not designed to trade around a lock limit down or a lock limit up. And
The risk
therefore,
reward's not there.
there's nothing there for them. So if they're not trading, you got to stay away. The risk is way too great.
Yeah, those algos that might be making a market, they're trying to make 1 to 2 ticks on the trades, but why try and make 1 or 2 ticks on a trade when I might be risking 40 ticks on a trade? It's a skew. So they turn those things off. And people that do maybe trade calendar spreads, that work into those those prices and the bids and offers, they're not participating either.
I have a few other questions that go beyond the scope of here. But that's great to hear. And I think we're going to keep this because it's a PSA. We've already ran over our 30-second TV time limit. So I think that we've explained enough for the beginning level of understanding limits. Remember to look at what your product has as far as limits, if it has it, and have a plan. Know what you're going to do in these situations.
Yeah,
And
one thing I want to just drop in before we sign off is all this information can be found on the CME's website, and they're always updated after the close, usually within an hour. Your limits are going to be set, told you for what tomorrow is. Settlement price will be in there. Every little detail you need is in there. So before you get involved in these markets, make sure you're going to that website, double checking everything, making sure your platform is lining up with what's being said on the CME's website.
that's exactly what I was going to say. Thank you, Dan.
And the good thing is, we can go vast periods of time without ever getting anywhere near one of these limits. But obviously, when we are in a situation when this is possible, it is extremely important to be aware of it and to know where those limits are.
Couldn't have said it better. So that's where we'll leave it for today's Coach's Playbook. Hogue, what should they do?
Hey, get out there and profit, trade well.
All right. Thanks, guys. We'll see you next Tuesday.